Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Pavitra Parekh, and it's turned out to be a very quiet morning of trade. Range-bound day, muted action so far. We've got important cues that the markets are tracking. One, the counting is currently underway in Gujarat as well as Himachal Pradesh. And it appears in Gujarat, BJP could come back to power for a record 7th time. That's, absolutely like stunning, the kind of results that we're seeing over there. So that's cue number 1. 2, it's also the weekly options expiry. And if you look at global cues, you've got the jobs data, the weekly jobless claims that the street will be tracking very closely. So ahead of that, things are on the quieter side.
Yeah, and I mean, in terms of cues, you've also seen that big drop in crude prices.
Yeah.
So it'll be important to see where that really moves. We're watching the entire China reopening, which was announced yesterday. So let's see, because Hang Seng now is seeing a big gain. It's actually one of the top gaining indices with a gain of around 2%. So Hang Seng doing very well. It'll be interesting to see how that entire reopening plays out. For our own markets, once again, it is the PSU Bank Index, which is doing very well. So that one will come up for you. That one is holding up with good gains. You have the entire FMCG pack also, which is holding up quite well. And, if you take a look at the downside, today, of course, it is pharma and also IT. And in fact, for this entire past week, these have been the two indices which have seen perhaps the highest cut. So the IT index for the week is down around 3.2%. You have the pharma index, which is down 2.3%. So those are the places where you've seen some weakness creep in. And also on the losing side today, you have a lot of the sugar names. So do keep your eye out on that pack as well. The likes of Triveni or Bajaj Hindustan are some. But there's an interesting note from Nomura and the entire auto pack. So Reema, you have the highlights from that?
So Nomura is saying that their channel checks seem to suggest that the blended discounts, which is a combination of the cashback, your exchange offers, bonuses, corporate offers, etc., offered by car companies in the month of December is higher than what we've seen in the month of November as well as December of last year. But this is more applicable for the small car segment, maybe your Alto 800, WagonR, etc. And that is indicating weakening demand for the small cars. So that is the numbers that Nomura has put up. And you would see that the discounts which are being offered in the month of December is higher than what we had in December of last year. They also go on to say that typically December does tend to have higher discounts because you are clearing out your year-end inventory, and next year you've got new launches coming up. But this time in the small car segment, discounts have gone up. In fact, discounts in the CNG variants have touched 60,000, which is the highest ever. But the automatic segment does not have any major discounts. And they're saying that if the small car demand continues to remain weak, then there is a possibility that discounts will be even higher going ahead, which can negate the benefit on the margins due to lower commodity prices, right? Currently, the street is anticipating that in H2, margins will improve because commodity prices are softening. But if the auto companies decide to offer higher discounts on small cars because of weakening demand, then that margin tailwind gets nullified, or, it's got a counter effect over there. They're also saying that the passenger vehicles, particularly all of it combined, that's your luxury, your sedans as well as the smaller car segment, industry growth rate is likely to normalize. So this year, it's expected to be 25%, but next year it's going to come to only about 6 to 8%. And thereafter, in FY24, even cost of ownership is going to go up because of the implementation of BS6 Phase 2 from April of 23 and the mandatory fitment of 6 airbags from October 23. So 1 year later will further increase the cost of ownership, so which will also weigh on the FY24 growth estimates, which is why they're saying that apart from the high base effect, so this year's growth will be 25%, but next year growth for passenger vehicles will come down to single digits, 6 to 8%. But let's cut across now to our managing editor, Shireen Bhan. She's at the CII Global Economic Policy Summit. She's in conversation with some of the biggest names from India Inc. Shireen?
Welcome the viewers who are watching this at their homes on TV. Gentlemen, thank you very much for joining us here this morning. Mr. Kotak, as I said, let's address some of the near-term issues, some of the short-term issues before we go into the medium and the long-term. I want to start by asking you about what you make as far as the interest rate trajectory is concerned. The MPC yesterday delivering a 35 basis point hike along expected lines, but the commentary also taken in by the market seems to suggest that the RBI is very firmly committed to bringing down inflation at this point in time and bring it within that MPC band as far as the inflation range is concerned. Do you expect another rate hike in February, or do you believe that if it is a rate hike in February, that will be done for now?
So, Shireen, I think the governor has spoken yesterday. And he has said that he will be data dependent. Therefore, we've got to take him at his word. And my sense is we've got to wait and watch for what happens to the Fed in December. I think that's going to be a very crucial signal about what is the interest rate trajectory in the largest market and the largest pool of money in the world, which is the US. At the same time, I think we need to watch the Indian situation. The target for RBI is 4%. And if you read the press interview where Michael Patra spoke, he said that we want to be within the band first and then towards the target. Therefore, based on that, my sense is there could be one more rate hike, and that may be the time for thinking about a pivot. But we got to watch very closely the data, and maybe around 6.5 as it looks today, subject to what happens to the world, subject to what happens to oil, subject to what happens to many, many other things. And based on that, I would say that at this stage, maybe 6.5 is where there could be a time to pivot.
Okay, a time to pivot at 6.5, and you talked about several factors that the MPC will have to consider. The good news, though, is that at least as far as oil is concerned, we've seen prices come off quite sharply, below $80 a barrel at this point in time. Sanjeev Bajaj, I want to understand from you, in terms of consumer sentiment, in terms of demand, India has been resilience versus the world. At this point in time, with rates moving up, are you starting to see any signs of that impacting consumer sentiment or consumer demand? Or do you believe that it's still holding strong?
You know, Shireen, if you look at the last few years and the effects of the pandemic, what you've seen is a two-leg recovery. You're seeing on the consumer side, the middle class, the upper middle class, that actually saved a lot of money. Most people did not lose jobs. Maybe they didn't get a big salary increase, but they didn't lose jobs. And we are seeing increasing spends. So if you actually see televisions, refrigerators, mobile phones, the more expensive ones are selling more. On the other hand, if you look at the low middle class, that is where you've seen much higher stress. And that's where we see a big drop in consumption. So that's one clear change that we are seeing compared to pre-pandemic. Second is that the government supported rural India significantly through the pandemic, as was expected. Some of that support is starting now naturally to come down because the government also has to balance its books. As a result, some slowdown in rural demand is also visible. So at this point of time, and I think it's as is reflected in the economic growth as well, and as projected by what RBI has indicated in the next 2 quarters as well, you're talking of 4.2, 4.1% growth. So you're going to see some amount of moderation there in the short term. On the other hand, everything that the government is doing, India is doing to build new capacities, to look at becoming the manufacturing base, the China Plus One strategy, has at least significant medium-term promise, but we have to execute naturally towards that.
You know, on the medium-term promise, I'll get to that in just a bit, but on this business of private capex, and I think it was at a CII event, or at least an industry body event, but the last time the finance minister once again asked Indian industry to go out there and invest and gave the Hanuman analogy, what are you waiting for? Why don't you recognize your own strength and the opportunity? Has that message now resonated deeply with industry? Are we likely to see any movement on that front?
No, not only the message. Let's give credit to the government for a continuous and consistent investment from their side in public infrastructure. That is really what has helped us over the last few years. Private sector, we are starting to see investments in the last few quarters, whether it's in real estate, construction, logistics, chemicals, some of those sectors. But there are many other sectors where there is still excess capacity. Eventually, private capital does have to earn a particular return to justify that investment in capital. And that's where I think it's more a short to medium term window that we're looking at for private capital to come back.
Sanjeev Puri, let me address the question both in terms of demand as well as private capex. As we just heard there from Sanjeev Bajaj, some impact continues, at least as far as the consumption side is concerned, when we talk about rural economy. And that has been the story for the FMCG industry as well. What are the trends that you're picking up? We're almost at the end or the last lap of 2022. What is the outlook for 2023?
So I would say that, first of all, it kind of mirrors what Sanjeev just alluded to. In the FMCG segment, we are seeing both the trends of premiumization, and at the same time, there's a lot of value-seeking behavior, and there is a stress at the lower price points, right? So it's the same reflection that is there. We are, of course, seeing India do much better than what the rest of the world is witnessing. And I think as far as consumption is concerned, the main stress point has been inflation-induced, because prices of a lot of products have gone up at a percentage that probably in the prior periods would have taken 5 years to go up by that kind of, it's all gone up in double digits. That's a phenomenal amount of inflation. And that's the reason why FMCG consumption volume growth in rural is a lot more muted. Of course, volume growth is muted across. The bulk of the growth is inflation-led, but there is some, volume growth also. Now, however, my sense in rural is that it is going to get better, because the realizations have been better. The costs are also up, but net-net, I think it's better off. But there will be certain regions that are going to be more impacted, and that's more to do with the distribution of rainfall and the impact of the receding, the untimely rains have caused in certain areas. So certain areas will be under stress, but overall my assessment is that it is going to get better over time. Inflation also, as far as FMCG is concerned, it's cooling off a little. Coming to the second point about private capex. Yeah. Now, see, the macros for investments, I think, are pretty good. If you look at the availability of funds, the corporate income tax, better balance sheet, so all these are positives. Earnings also are on a better trajectory. The issue really comes to is about capacity utilization, which is also picking up, but there is a serious amount of global uncertainty.
Yeah.
And there are serious headwinds on exports, so that's going to dampen sentiment. But I can tell you that for companies like ours, which are very domestically focused, I think that private capex is continuing. We've already done, and some more is in the pipeline. So for domestic oriented, I think it's an ongoing process and it's happening.
Okay. Mr. Kalyani, let me address both the domestic market as well as the global environment with you, because you have a pulse on both, especially in light of the government's move to, at least as far as the defense manufacturing is concerned, to indigenize much more. You've got the third list that's now already out, and the uncertainty as far as the global environment is concerned. How is that likely to shape things over the next 12 to 18 months?
Well, I think the challenges in the global environment, which all of us know, the war in Europe, the challenges of the China +1 strategy that many countries are facing and trying to figure out, and the challenges of creating a resilient supply chain. You go to any place, anywhere in the world, you will hear this word, resilient supply chain. What is a resilient supply chain? I think in the manufacturing world, this creates huge opportunities for India, including in defense, by the way. But there are pockets of opportunities where things are happening at a much faster pace. I'll give you the example of railways. The railways are undergoing some tremendous modernization. Just day before yesterday or yesterday, a tender was out for 1,600 locomotives of 9,000 horsepower. Siemens was the lowest bidder, 20,000 crores. It is all supposed to be produced in India in an Indian plant. In one more week, there's a similar tender out for 9,000 horsepower locomotives, which is going to come out, and then 200 Vande Bharat trains, and then 100 high-speed trains. Now, this is the kind of initiative that Mr. Vaishnav has taken in his ministry to create industrialization of the railway manufacturing system, which was somehow embedded in the last century for many, many years. And overnight, this is going to get completely modernized. What took Europe and America 50 years to do, India will do in 10 years. And this is going to create a huge manufacturing ecosystem, especially in the area of electrical equipment, because these are all electric. We have, as a policy, Indian Railways have moved from diesel to electric. as you know. The same thing is happening in defense. There is a whole slew of policy changes that have taken place in the last 3, 4, 5 years. Everything is focused on Make in India, and more than Make in India, focused on what the Honorable Prime Minister calls Atmanirbhar Bharat. And his definition of Atmanirbhar Bharat is very clear. Atmanirbhar Bharat means something that you produce with your own intellectual property. If you got a technology collaboration from some company, no matter which part of the world they come from, and you want to export that product not into a conflict zone area, but even in a non-conflict zone area, you won't get permission to do it. But if it is your own product, where you own the technology, you will get it. If the Defense Ministry starts doing what the railways are doing in terms of creating this large industrialization capabilities, then I think India will have a game-changing situation in manufacturing for the domestic market also. Because when you do, whether you do railways, whether you do defense, whether you do automobile, it's not just that industry that you're dealing with. You're creating a whole host of new technologies which have usages in many, many other areas. And that creates an ecosystem, that creates skill sets, that creates capability. So I'm very confident that that sector is going to do well.
Both railways and defense. You held up the railways as an example of things moving very fast. Defense not fast enough?
Not fast enough yet.
Not fast enough yet. John Major Sinha, let me address the issue of the India story and the strength of the India story. Practically every interview that I've done in the last few weeks, whether it is with a domestic CEO or more importantly with a global CEO, everyone's talking about how this is going to be either India's decade, if not India's century. I don't want to go down the century road, but let's talk about the decade that we are dealing with at this point in time. What do you believe are the areas where we have enough momentum to push us forward, and where do you believe work needs to be done?
So if you just look at the world, Shireen, if you take five blocks, the US is about 22 trillion, Europe is about 17 trillion, China is about 16.5, 17 trillion, Japan is 5 trillion, and UK is 3 trillion. Look at each of these countries. The US has a very, very complex situation, that it has inflation which is higher than India. I don't remember in my living memory when this has ever happened. And the Fed is driving up interest rates to bring about a recession. I mean, the decided goal is to bring a recession. Europe will slip into a recession in a month or two, with very high energy prices and with a complex situation that it's importing inflation because of oil prices, and not the US situation which has had $5 trillion of stimulus. Then you come to China, which is decided that, it's had enough of a run, and only thing that Xi Jinping wants to do is consolidate power. And so I hope he continues to consolidate power and create opportunities for India, because they are really have self-inflicted a goal which they are trying to unwind, and they're going to have a very hard time unwinding. Japan, the yen has gone down to 140. It's still not raised interest rates. So it's in a complex situation, and it's aging very rapidly. And UK changes its prime minister every 10 days. So, if you really look at that context, India is a beacon of stability, which has a fiscal balance which is coming about. We have some headwinds and we have some tailwinds. But overall, everybody who looks has to say, if you have a country, which we will be the largest country in the world in terms of population, we have started to grow, we have started to have a market size, what I call the Indonesia of India. So if you take 50 million Europeans, 400 million Indonesians at $10,000, that in itself is very attractive for the world. And then we have, yes, oil prices going up, but if there is going to be a recession, the oil prices will moderate. Interest rates, we will have a little bit of a tough time with that. But if you look at the MSCI index, it has taken us from 7 to 14.5%, and China has been brought down from 36 to 29%. This means serious amounts of dollars are going to be coming towards India. What do we do with it? That's the question. We have some constraints which are there, which have to be addressed. But how do we take advantage of our many trends that are there is going to be what it will be on us. So if we don't take this decade, the only people we should say shame on is us.
Well, yes, I would imagine that that is going to resonate well with the audience that is listening to you. But Mr. Kotak, let's address this issue of India versus the world at this point in time. The next big policy event that's coming up is Budget 2023. Now, industry has presented its recommendations, a usual list of recommendations that go in year after year. But if we were to talk about the budget in the context of what's happening in the world, whether it's China +1, it's re-globalization, it's supply chain resilience, what do you believe thematically the priority areas should be for Budget 2023? What should the theme be for Budget 2023?
You know, Shireen, I just want to step back and actually bring some reality.
Okay.
And I think there's a lot of good news. There's a lot of opportunity as has been rightly highlighted. But I just believe that we need to set our goals and then execute to the goals. Therefore, as Janmay mentioned, we are now the 5th largest economy, around the size of UK, on many days bigger than UK, on some days around that. So that's a great achievement. The first goal we must set for ourselves is, what does it take for us to become the top 3? So that is, and how do we get there? And in that context, obviously, absolute GDP does matter. And for us to be in the top 3, we will have to, from a 3 trillion, think about a number which is double-digit at least.
Yeah.
Okay. And we can figure out the time frame within which we need to do. So we are a long way from top 3, but a lot of work to be done with focus. The second important point is we have to keep the reality check that we have a denominator challenge, which is 1.4 billion people. A UK has 68 million people for a 3 trillion economy. For a UK per capita is $47,000, India is 2.5. And I think if we want to become world class, we should get out of this mindset of PPP and other things. Let's now compare ourselves with the best in class, dollar to dollar. And what does it take for us in the next, say, 10 years to think about a per capita GDP which is as close as possible to $10,000. At $2,500, even if we double it at 7%, it gets to 5 in 10 years. We need to go faster in dollar terms. So let us work towards absolute top 3 and per capita to move to a serious middle income country with a 10,000 per capita. And I think Baba and Sanjeev, both the Sanjeevs and all of us, we have optimism for India's future. But if we want to be truly Atmanirbhar, we're going to ask ourselves, how do we get better on 2 profit and loss accounts of India? One is current account. Yes, a growing economy needs to have a current account deficit. And we keep on having a current account deficit for a long period of time. But at some point of time, we must be Atmanirbhar. Even this year, we will be $120 billion negative current account deficit. Means our profit and loss account in foreign exchange is we are earning less than what we are spending. Therefore, we need to get Atmanirbhar on our current account. And second, I understand fiscal deficit consolidated has gone up worldwide thanks to COVID. And India is at consolidated, give or take, around 10% of GDP. We need to have a credible, consistent, resilient plan that we will get better on P&L account, even on fiscal deficit. Therefore, total GDP, per capita GDP, and getting our 2 profit and loss accounts right, and whatever it takes for us as business and policy working together for that clear objective set in front of us.
No, but that's what I want you to focus on now. Whatever it takes. So what is it going to take? Let's talk about that, Mr. Kotak. Ambitious goals, audacious goals that you've set out for us in terms of being able to get to $10,000 in terms of the aspiration. But what is it that you believe will take us there? And, what should the priorities be?
I share with the finance minister. People in this room and on this dais need to get our animal spirits up a lot more. And it really is it. Investment.
So what is holding the animal spirits back?
I think
If you're optimism, you're confident about the growth of the India story in the near term as well as the long term, then what is holding animal spirits back? Liquidity is clearly not a concern.
I think there are a number of factors. First, the global situation thanks to COVID and Ukraine has made a lot of people in India circumspect. In a 24/7 news, if you keep on getting barrage of bad news from around the world, it's got to affect your psychology and your mind. And we are not immune to this. I remember in 2008-9, I took a call. Don't read the Financial Times and the Wall Street Journal. It makes you very negative about the world and you start taking negative.
Only watch CNBC-TV.
Not CNBC or CNBC.
CNBC-TV18.
Okay. So I think the fact of the matter is 24/7 digital world, what happens around the world affects us. But we got to look at our facts. We did a survey in Kotak of 900 corporates and SMEs recently, first week of November. We found 66% of the companies across corporate to SME having capacity utilization of 80% or more. But only 15% of the total were ready to invest for new capex. So capacity utilizations in many areas are going up, but people are waiting and watching because of perceived uncertainty. And that is where confidence, capacity building, and I think building capacity in each sector ahead of the curve. I think the financial sector, we really need to figure out if we want to be a 5 trillion economy, our financial sector has to be at much larger scale with greater ambition than where we are. And that's true for many, many other sectors. And I'm sure my colleagues here would share. How do we take the bets without fear that, what will happen to the world? What will happen to exports? What will happen to some policy change? What will happen to the regulatory landscape? There is concern in many areas, therefore people are uncertain. Let's unwind that and move forward.
Hey guys, welcome back. You're still tuned into Trading Hour on CNBC TV18. For the market, it's around a 20-point gain that we are seeing on the Nifty right now. And a lot of this actually coming through from the banks today. So that index in itself is up more than 300 points, 340 points to be precise on the Nifty bank. And the mid-cap index is also not doing too badly today. So it is seeing a gain of around 0.25%. So that's what's going on with the markets. But let's get you a conversation now. Amit Gupta, VP and Fund Manager at ICICI Securities PMS joins us now. Amit, good morning. Thanks a lot for joining us. This is Pavitra. My first question to you is that we hit these all-time high levels, and ever since then there has been all of this global news which has kind of kept gains quite ranged. Do you think this is likely to continue and we're not going to see too much in terms of a gain from here at these levels?
So global news we have been, seeing for the last now 1.5 years continuously. In fact, we saw very more severe macro headwinds actually before. But market slowly is getting absorbed actually all of this. In fact, the inflation levels, what we saw 4-5 months before, it was very steep. If you look at it in US also above 9%. Now it is sliding. I think this is where the market is getting some comfort now. The bond yields, particularly in India, if you look at from May onwards, despite the interest rate increase in repo, we did not see our bond yields going up. Rather, the US bond yields actually were going up in that period. So they had a correction and we did not have any major correction. So we remain in the range. And now we are seeing when the inflation is cooling off, the bond yields also are, slowly cooling off. So whether the interest rate cycle will remain like this or you will see a slowdown in the interest rate cycle, I think the later part can happen now. But some increase in interest rates still can continue because the central banks, they are not getting comfort yet from this decline in inflation. So this trend has to continue actually for long. So for Q4 financial year 23 now in India at least, we are expecting a move towards 6%, which I think we have to watch it now. And that is where you will start seeing the commodities decline finally going in favor of decline in inflation. And you will see more commodity user companies also having a good time now in the second half of this financial year.
Are the markets being too complacent, Amit? Everyone's saying that India is a great structural story, things should improve. But the truth is valuations are elevated relative to history and the other emerging markets. And we're still unclear about the extent of growth slowdown in the Western world, whether it's going to be a mild recession or something even more than that, stronger than that. So there is that element of uncertainty. So should one go, all in the markets, or is it time to perhaps take a pause, let the first half of the year evolve, or at least the beginning of the year evolve before, dipping your toes in the markets once again?
So I think few points here. If you look at the slowdown in the developed markets and the impact on us, obviously we are bound to see this. And that is where it will not be an easy ride for the markets. You will see more consolidation, more time correction, but the trajectory looks upward. Because if you see the merchandise export from India, for example, when the PLI started, we all were looking for the import substitution. But ultimately, it is converting into the export also. And you saw that from 2012 till 2020, the merchandise export was around $300 billion from India. But now in the last 1.5 years now, we have seen a structural turnaround in this export. It has moved to almost $420 billion. So after this slowdown, it is possible $30-40 billion can be shaved off again. But at least from 300, still you will be at 390 or $400 billion, which I think is a structural move in this. And that really benefits India. Second, if you see our valuations now, so for financial year 24, which the market is discounting, so slowly we saw from 1000 EPS, it declined to almost 930, 940 EPS. But now we have seen that there is some upgrade actually happening there, not only for financial year 24, but also for financial year 23. So at least 4-5% of upgradation has happened for 24. And that is where that particular EPS, if you see on an average, is somewhere around 960, 970. So in that case, the price to earning for Nifty is somewhere around 19. The last 5-year average is somewhere around 18.5. Because we have seen many high PE stocks coming into Nifty, whether it is Bajaj Finance, Finserv, Titan, Britannia, Tata Consumer Products. So all of them are high PE. So the last 5-year average is around 18.5. So we are not too far from there. Yes, when we compare with the emerging markets, the overvaluation definitely looks like, because they have underperformed. We have not underperformed that much. We have remained flat. So this is something that can lead to more time correction. And eventually, when the inflation is cooling off, it can cool down further. We may see those markets also rebounding. So our premium vis-a-vis them, possibly it may not look so much steep what is happening right now.
All right, that point is taken. Amit, coming to you on just the banks, because I know you do like this space. With this entire pack having rallied so much, do you think that there is still room for significant upside in the banking names? So if someone is to put some fresh money to play, do you think this sector still is attractive at these higher levels?
So I think till last year, if you look at Bank Nifty, it was not going anywhere. It was just stuck in a band of, I think, 32,000, 38,000 around. And we were all wondering why banks are not moving up. And the reason was very simple, that credit growth in the banks was not picking up, despite the fact NPAs had come down substantially from almost 11.5 lakh crores in 2018 to almost 5.5-6 lakh crores actually now. But the bank's bottom was made, but actually that growth was not coming. And now when the credit growth has moved from 5% to 17% plus, we have seen that the banks have started participating. I think there is a lot of demand which will come for credit. Initially, the companies, because they were sitting on a lot of profits, they were going from internal accruals for the expansions. Though the expansions also started late, but they were doing it. But now we are seeing that some borrowing has also started happening. So whether it is retail or SME or corporates, all of these segments are coming back. Corporates, though initially it was more for the working capital requirement, but eventually if you look at the capex from metals, cement, chemicals, ultimately it looks that this private capex cycle is slowly picking up. From the last 2 quarters, very clearly we have seen this trend. So our sense is, whether it is a private or the PSU banks, both of them are the beneficiary of this credit cycle right now. The only thing is, how much will be the price to book goes, particularly for the PSU banks, because they were trading at a very sharp discount, but that is now coming back. because ROAs are recovering, return on assets are improving, and on this increase in the loan book. So SBI loan book, if it has gone to 29 plus lakh crores, its ROA has gone to 1% now. So it gives you more profitability. So if you look at in this quarter, out of 58,000 crore of profit in the banking system, we saw that 26,000 crore came from the PSU bank, and 32,000 crore came from the private.
Okay, Amit, we'll have to leave it at that. Thank you very much for joining in. That's a very comprehensive conversation, the outlook on banks. Get into a break. On the other side, we'll discuss market technicals. Jay Thakkar of Marwadi Shares and Finance joins in next. Welcome back. Markets flat, but Axis Bank is seeing a lot of strength. It's moved to a fresh 52-week high. The stock is up 2.5%, rallying for the third day in a row. IndusInd Bank has gained close to about 2%, and spikes coming through in a couple of commodity names. So pull up JSW Steel and Hindalco. Both these stocks have started inching up. Jay Thakkar of Marwadi Shares and Finance is with us now to talk about the market technicals and the charts that he likes. Jay, any index trade and the stocks that you would recommend?
Hi, very good morning to you, Rima and Pavitra. Well, of course, Bank Nifty has clearly provided a breakout above the levels of 43,200, 300 range on the upside, and definitely it's inching towards the levels of 43,700. I mean, definitely there is somewhat pressure around the levels of 43,500 today being an expiry. I mean, that's the level to watch out for as far as the call activity is concerned. We are seeing good amount of open interest at the strike of 43,500, but I believe that with this kind of a breakout and the kind of momentum which we are already seeing in the banking pack overall, I mean, you just mentioned about Axis Bank, Bank of Baroda, or maybe Federal Bank, and most of the PSU banks are in good upward momentum. I think, Rima, that it's heading towards 43,700, and hence Bank Nifty can be bought at current market price. I'm recommending the spot levels. I mean, one can place a stop loss below the levels of 43,250 on a closing basis, targeting 43,700, 43,800 in the immediate basis. And as far as Nifty is concerned, I would say that yes, the possibility of a bounce back year two is there. I mean, there's a very nice support around the levels of 18,500. And I don't feel, Rima, that today Nifty will be closing below 18,500. I mean, there is a very remote chance of that being happening. In fact, the probability of Nifty closing above 18,600 is higher. It's just that if at all we get a dip, then it could be a good buying opportunity of Nifty as well. On Nifty as well, I am seeing an expiry about 18,600, nearly around 18,650 levels. There should be the expiry. These are the trades on the indices. I mean, as far as the stocks are concerned, I have two buy recommendation. The first one is definitely from the banking pack, and then that's on the private sector bank, HDFC Bank. The stock has been consolidating and formed a good, nice symmetrical triangular pattern on the daily charts. The risk reward is absolutely in favor of the bulls out here. The stock is trading around the levels of 1615. One can place a stop loss below 1590, 1590, and target 1660 on the upside on the immediate basis. And the second buy recommendation is on Gujarat Gas. Now, this stock too has formed a nice symmetrical triangular pattern. The move prior to this was an uptrend. Hence, I believe that this is a continuation pattern. The indicators are well in the favor of the bulls. The range breakout can help this stock to inch towards the levels of 550. That would be the first target, and the second target would be 575. So one can buy Gujarat Gas for targets of 550, 575, and one can place a stop loss below 498.
All right. Thanks a lot for getting us all of those fresh trading ideas. So you do see a close above that 18,600 kind of mark. So let's see how the session moves from here. But for now, we are going to get into a short break. When we come back, we're tracking lots more market action. There's also an interesting note by JP Morgan on L&T Tech. So we'll bring you the highlights on the other side.
In 23 years of business leadership.
Welcome back. The Nifty IT is subdued today. The Nifty IT index is down 0.3%, but in that, L&T Technology has been an underperformer. Now, JP Morgan has written a note on L&T Technology where they're saying that we get a lot of questions from investors asking that why does L&T Technology trade at a premium to the rest of the mid-cap IT basket? And according to JP Morgan, that valuation premium which L&T Tech enjoys over the other mid-cap IT companies is not justified because L&T Technology is not growing at a faster rate than the other peers. Now, they're saying for FY23, L&T Technology company has guided for a revenue growth of about 16%, 15.5 to 16.5%. But this is lower than the growth rates that other mid-cap companies are tracking, the other IT companies, which on an average is about 25%. They're saying even during the high growth phase of FY19, when the company grew 27%, the stock was trading at 26 times. But now when the company is growing at 16%, the stock is trading at 34 times. And also, they highlight that the company itself has spoken about cautiousness impacting deal closures in high-tech and medical devices. They're also seeing some seasonal furloughs in Q3, which will impact the growth momentum in the second half of the year. So they're saying any disappointment on either the Q3 print or incremental negative commentary can drive a derating, which is why they're reiterating their underweight stance, and they're saying that the valuation premium that L&T Tech enjoys over other mid-cap peers is not justified. So that report is weighing on the stock today. Get into a break. We'll come back with more on the markets.
CNBC-TV18, celebrating 23 years of business leadership.
Welcome back. The market is now moving closer to the flat line. So just around a 16-point gain that we are seeing on the Nifty right now. So we are seeing a little bit of a move lower. What was holding up quite well and still continues to look quite steady is the banking pack, although there are individual names such as Kotak which have moved to the low point of the day. It is one of the bigger gainers, bigger losers as well right now. Another stock which has moved to the low point is Reliance, which could be exerting some pressure on what you're seeing on the frontline index as well. So that one also at the low point of the day. But the real strength, once again, like we've been pointing out, is in the PSU Bank index. That one has only moved up and is currently seeing a gain of around 3.2%. Remember, there is a Credit Suisse note on PSU banks, and on the back of that, you have a lot of these stocks which are rallying well. So that's what's going on with the market. We're going to wind down on that note. Thank you very much for tuning in. And Halftime Report will take all of this action forward on the other side.
CNBC-TV18, celebrating 23 years of business leadership.